Well, we mentioned there are some economic concerns that are weighing on stocks in the first couple of minutes of trading on this Monday morning, and yet the tone recently has been pretty positive compared to where we were. Let's bring in Scott Wren. He's Senior Global Equity Strategist at Wells Fargo Investment Institute. Scott, always nice to see you. Let's just talk about the mood of the market this morning. We spent a lot of time already talking about the worries out of China on their economic front. I haven't spoken as much about the latest gauge of economic data, but in New York State, manufacturing activity was down quite sharply in the most recent read. So you've got these messages of a cool down, but I have to put that in context on where the market's head already is. So why don't you walk us through that?
Well, I tell you, John, we've you're seeing some of these fundamentals, slowly deteriorate, whether it's initial jobless claims going higher, whether it's the Empire Index that you just mentioned, which of course was a terrible number. We know what's going on in China. Europe's not doing a whole lot. So from our perspective, things are slowing down. The activity in the second quarter was obviously we had a negative quarter of GDP there. We think the economy is probably going to be worse here in the fall. We think they'll probably call an official recession, the NBER, who is never very quick with doing that. Now, sometime in the next couple of months, somewhere down the road as they look back, they'll call that. So we're still expecting a slowdown here. We think street earnings are too high for this year. We're at 200. I think the street consensus last time I looked was at 220 or maybe a little north of that, and that'll come down a little bit probably after this earnings season. So I think the story is that you still need to, even though we've had obviously a nice rally here, a nice bounce off the lows, is you still need to think about capital preservation. We've broken through some resistance. Technically the market doesn't look bad. We've got the 200-day moving average coming up a little bit over 4,300. But if you look at the fundamentals and, what the Fed's likely to do, which in our opinion is continue to hike rates, we're going to see higher unemployment. We're going to see more of a slowdown. And so for us, we're still playing defense, and I think that's the way you want to be.
So I just want to put a couple more numbers around the market, and both today and historically, and then kind of ask you a follow-up to what you're saying about being cautious right now. So you mentioned when we historically get a recession called, and usually it is late in the game. I think the data I saw most recently suggested that usually by the time we get that official recession call in the United States, we're about 3 months away from the official end of that recession. And then for the market, I think going back to the 80s, I saw some data last week suggesting that by the time you get that call, that we're only about, give or take, 90, 100 days away from the bottom in the market. And I'm sure some people are going to start thinking a little bit about that if they're dipping their toes in the water right now. What is it that you think hasn't maybe been baked into the weakness if you're being cautious at this point?
Well, I think John, as I mentioned, earnings, for instance, I think the street is still too positive there. And you're right on the timing of this thing. We've been playing defense since March. And as you look out and you look how cycles normally play out, about halfway through the recession is when the market kind of bottoms out and starts to work higher. So, the next move for us probably as we try to look ahead, we think the recession will probably last, maybe until the middle of next year, something like that, a moderate recession. So, we're looking at shifting from more defensive sectors like healthcare into something that's a little more assertive or would do better as we pull out here, like industrials or consumer discretionary or something like that. So that's the kind of timing that we have to think about as we move forward, because the market is going to think ahead here. But I think for us, in my opinion, the markets knows what the Fed's going to do this year. And, you're splitting hairs saying, are they going to hike, 50 basis points in September or 75? I mean, we think they're going to go 75. That to me is not the question. It's what's the Fed going to do after the start of the year? Are they going to continue to be aggressive? I think that's what the market is hanging on. And we've certainly seen some good news here on inflation, but, we're not going to drop anywhere near, let's say, south of 3% in inflation anytime soon. So the Fed's going to keep hiking. Earnings are too high. The thing that's, sentiment's been really washed out. Everybody was negative and leaning the same way. And so it makes sense that we had a pop here, but we're probably going to cough some of this up probably over the next month or two.
I always like to make these conversations as actionable as possible for our audience as well. We've talked about the macro stuff. We showed a graphic for our television audience and some of the areas you're still leaning towards, which, by the way, would include technology, which has had that bounce. We were talking about it earlier in the program. Healthcare, certainly a lot of those juggernauts in the U.S. are in a position to, have some attractive things like dividends, et cetera. But you've got energy on that list as well. And we're watching oil under pressure today because of the worries out of China. This is such a hard trade for a lot of investors who likely had thrown in the towel on some of their oil stocks coming into 2022. Then you see this rip-roaring rally. Give us a sense on, now that there's this fresh worry about the story of oil going forward, at least for oil investors, why it makes your list right now.
Well, we think the market for oil is going to continue to be tight, and our commodities group, this 85-90 area, this is a pretty good area to stick your toe in the water if you want to try to invest in oil or energy related stocks. So, for us, oil will be 100, maybe a touch more by the end of the year. So we think the sell-off that we've seen there is more temporary, and that supplies are going to continue to be tight, and that's not going to change. We know there's a slowdown coming. The market, to some extent, at least in our opinion, has priced that in. But here in this $85-90 area, that gets us interested in oil and just energy overall.